What's going on, everyone? Erik here from Outlier Trading on YouTube. You can check me out there whenever you want. Today, we are going to talk about trading earnings with options. Earnings are really cool because they are what we refer to as a binary event, meaning after an earnings release, there's a rapid dissemination of information. And the great part about that is that there are certain effects that we can predict fairly reliably leading into earnings release itself and then following earnings releases. So we're going to talk about 4 of those effects and 4 ways you can trade them. Let's get straight in. You already know we got to start with the disclaimer. I'm not a financial advisor, nor am I a part of Barchart. I enjoy making content for them, for you, so that we can all learn. That is the goal here. Beautiful. Let's continue. Let's talk about the very first effect, which is volatility tends to expand starting about 2 weeks out leading into an earnings release. Now, I'm going to overview these effects with you quickly. I'm going to show you them, and then I'm also going to show you some studies that you can look up for yourself to validate them. So we'll take a look at a bunch of bar chart related tools in just a few minutes because they have some great platforms that can help you visualize these things. However, I'm going to show you one view from my platform, which is Thinkorswim, because it helps visualize the relationship between implied and historic volatility really well. So volatility tends to expand starting about 2 weeks out leading into the earnings release. So essentially, this orange line is implied volatility. And then this yellow line is historical volatility. And notice how high this line is. Now, you can see implied volatility will tend to bounce around a little bit. It's not always going to be directly upward sloping into the earnings release, but it's generally going to have a much larger gap between implied and historical volatility. That's elevated volatility. And that starts about 2 weeks out. After the earnings release itself, however, it actually contracts. So if you see the earnings release here, it's essentially the dotted line. And then you can take a look at implied volatility, how it has this really steep sloping line more often than not following the earnings release. That's implied volatility contracting. Now, again, it's not always. In this case, it actually went up a little bit. That will happen. None of this is perfect. We are talking in the aggregate. So the way that this first part works is there's a little bit of a runway leading into the earnings release, and then volatility immediately following when the earnings are released. All that information is disseminated. All of the unknowns are now known. We understand the next projections, because that's a big thing about earnings, is not just reporting what happened over the prior quarter, but the expectations given and the guidance for the following quarters so that we can then attempt to discount cash flows. That's the idea of the stock market. It's a discounting cash flow mechanism. So those are your first 2. Now, moving into the third, price can and often does move heavily following the earnings release. So what that means is after the earnings comes out, if there's some sort of drastically news information, in this case, we're looking at McDonald's in this example, and take a look, you can see that there's a big giant gap here. Or you can see other instances where sometimes it doesn't move a whole lot. Again, this is dependent on the circumstance. It's not always going to happen, but very frequently, if there's new information that's injected that wasn't expected, you will see those kinds of moves. And then the last thing here is that we can expect, if certain circumstances are met, to experience post-earnings announcement drift. And Barchart has a fantastic tool for visualizing this. If you take a peek at this chart here, and let me move it over a little bit more so it's easier to see. And I want to show you a couple key effects. The first thing is, zooming it in just a little bit more. The first thing is, if you take a look at the different releases, notice how when there are these larger surprises, meaning in this case it's to the upside, take a look at the behavior of price over the following quarter. It's drifted up. So one of the big hallmarks that you will find is that if there's a significant earnings surprise, either to the upside or the downside, very often you will see a drift in that direction for the following quarter. So then you can see again in this quarter right here, that it had a surprise of 16.67% on EPS, and it did in fact rally into the next earnings release. So this is very, very common. It can also work to the downside. And as promised, I told you that we would take a look at some studies, which you can look these up for yourself on SSRN. And this will give you a better look into some of the qualities of post-earnings announcement drift, how volatility behaves, because all of this should be things that you can verify and validate on your own. And these studies are a great place to start. So here's the first one. This one talks about earnings movements pre and post, and it specifically is going to hone in on volatility in the stock price. This one includes during kind of systemic shock periods, which in this case, it's looking at post-earnings announcement drift if it's impacted by something like COVID-19. So we're looking at post-earnings announcement drift, but we're adding another variable, meaning that there's something big going on, in this case, a global pandemic. And then this paper is pretty interesting because it summarizes 50 years of post-earnings announcement drift research. So lots of tools available to you to dig in. Now, let's talk about how we can actually trade some of these. And it's pretty simple. So to trade volatility expansion, if you have no directional disposition, you can trade things like long straddles or strangles. Those are relatively price neutral and they're just expecting movement. Now, the expiration that typically makes the most sense is the expiration cycle that includes the earnings release itself. For volatility contraction, we would want to be playing some sort of short option. Again, this is if you're just playing volatility, not a price thesis in this instance. And normally we would want to put on the short options right before the earnings release, and then we would want to take it off sometime the next day. Now, normally in the beginning of day, there will be a surge of volatility as things start moving around. So maybe give it a little bit of time, 30 minutes, an hour, and a lot of the volatility will start to contract. And again, if there's no directional disposition, stuff like short straddles, short strangles are good use cases for this. And then if you have a smaller account, or if you want to hedge your risk a little bit, you can buy the wings. So you could do things like short iron condors or an short iron fly, something like that. Then to trade things like an expected price movement following an earnings release, we would want to use either short or long options depending on our profit mechanism that we're trying to capture. So for example, if we're expecting some sort of really big price movement following an earnings release, even though we know volatility is going to contract post-earnings release, sometimes it might make sense to buy the option, maybe go a little further out in time, so that then you can try to capture a little bit more of the move. Because if you sell options, your profit is going to be capped at whatever the credit is you receive. So if you expect a big move, you might not see it. Or inversely, you're not really expecting a giant move, but some sort of movement post-earnings release, it can be completely okay, instead of selling the straddle or strangle, to sell the calls or the puts by themselves, maybe turn it into a vertical, again, to manage margin requirement and also to make sure that you don't have blowout risk in case it doesn't do what you want, because then that will still benefit from the price direction. Again, granted that in the hypothetical situation, you're correct. And then it'll also benefit from volatility contracting. So you'll have a little bit of wind at your back. Now, to trade something like post-earnings announcement drift, we tend to wait until after the earnings release has occurred. So in this instance, if we go back to take a look at this, we wouldn't necessarily want to trade the post-earnings announcement drift before the earnings release, because you're kind of taking a risk that you don't really know which way it's going to go yet. And then you're building a position that's predicated on certain conditions that may or may not happen. So the way that I like to do these personally is if I'm trading the drift, I'm going to wait until after earnings is released. I'm going to look for the stock to have a nice big gap up or down, depending on if I'm trading it up or down. And then it also needs to be accompanied by significant EPS surprises. And that tends to provide a little bit of a shock to then drive value over the following quarter. Now, another really cool thing to take a look at is this volatility chart. Now, this is for McDonald's, and this actually allows you to visualize the volatility that's expected during an earnings cycle. As you can see, implied volatility for this upcoming week is very, very high because it includes earnings, and then it slowly trails down on a relative basis as you get further and further away from it. So it's actually kind of cool to be able to visualize this as neatly as Barchart allows you to here. Now, another really cool tool from Barchart is maybe to help us inform the way we might want to position something. You can take a look at this tool over here called options flow. You can throw in the ticker you want to take a peek at, and then you can limit it by a specific expiration date. In this case, we're using 1 November to isolate earnings. And then you can see how people are positioning leading into the earnings event. So we can see, are we a little bit bearish leaning or are we excessively bullish leaning? In this case, it's a little bit bearish. That's very normal for bigger companies leading into earnings because people tend to have big stock positions. They'll hedge with options to protect the downside if there is a downside gap. So if you see a bearish tilt like this in a large cap stock, that doesn't necessarily mean that people are betting it to the downside. More often than not, there's a hedge involved. Now, for smaller stocks, it's a little bit different. Smaller stocks, that tends to show a directional preference. But the next thing you could do is go through some of these larger trades and see what the lean on those trades are. And again, that can help us identify individual people that might be speculating on a direction, what direction they might be leaning towards trying to trade. So lots of tools to dig into here. As always, if you have any questions, just let us know. Be an outlier. We'll see y'all later.